To illustrate a problem where a company may be deciding whether or not to eliminate a department, we have this one where Campus Bookstore is considering eliminating its art supply department. So the problem definition: should the company eliminate the art supply department? Well, the analysis. If the bookstore dropped the art supply, it would lose the revenues of $100,000 annually. The bookstore's management assigns costs of $110,000. $80,000 is variable and $30,000 is fixed. That's how they get the $110,000. Therefore, the art supplies has an apparent annual loss of $10,000 because it has sales of $100,000 and it has costs of $110,000. So it has a loss of $10,000. But when you look at the cost, variable costs are $80,000 and fixed are $30,000. But careful analysis reveals that if the department was dropped, the reduction in costs would only be the variable costs. The fixed costs would have to be picked up because they are allocated. They're not eliminated because you eliminate the department. You have empty space now. You still have overhead costs and other fixed costs that were being covered by the art supply. These fixed costs will continue to be incurred and could not be saved by closing the art supply department. Look at the incremental analysis. Note that the art supply department has been contributing $20,000 to it. That is, $20,000 to the fixed costs towards covering the fixed costs. So the decision here is to 1, keep, or 2, close. Well, if I keep, I get the $100,000 coming in revenue. If I close, nothing. So incrementally, the cash inflow is $100,000. The cash outflow is only the variable costs of $80,000. The fixed costs are the same for both alternatives. And what is relevant here are the future cash flows that are different between the alternatives. So when we're looking at this, the future cash outflows, or inflows is 100, and cash outflow is 80. So there's a net cash inflow of 20,000, which contributes to the fixed costs. Now, unless the company had profitable use for the vacated facilities, the potential income from that alternative represents an opportunity cost for retaining the product segment. Okay, assume the bookstore could use the facilities currently occupied by the art supply department and open a new department, then that's a different analysis, and it would have to look at the cash inflows and cash outflows for that. But here, the decision here is to keep the arts department because it is contributing $20,000 in cash flows to the fixed costs.